The COVID-19 pandemic caused chaos in the housing market, with prices skyrocketing, inventories dwindling, and bidding wars reaching epic stakes.
Housing in the burbs is red hot because of the pandemic, but there's so much demand that there's not a lot left to choose from.
It's actually very hard to get a mortgage, even though rates are low.
Inflation's a real worry.
Then came record inflation, which drove the price of everything higher.
It's impacting decisions about how they spend their money.
We at the Fed understand the hardship that high inflation is causing.
The U.S. Federal Reserve, though, is waging an intense fight against rising prices, using interest rates as its primary weapon to fight inflation.
Mortgage rates not only surged to the highest level since 2000.
A side effect of raising interest rates, though, is higher mortgage rates.
In 13 years.
What's more, the Fed now owns $2.7 trillion in mortgage bonds, part of its plan to prop up the financial system when COVID first started, and it began selling them in June. So what does the Fed's fight against inflation mean for the red-hot housing market?
What the Federal Reserve is doing right now is they are raising short-term rates. That would be the federal funds rate. This is interbank lending.
The interest rate broadly differs depending on what you're talking about. So your interest rate for government bonds is very different from your interest rate on your mortgage, which is very different from your interest rate for credit cards, which is different from your interest rate on car loans. But what really anchors all of them is the 10-year government bond in the US, that interest rate. And that's the anchor because that is the ultimate in safe haven asset. That really anchors the entire market, and 10-year government bond yield or interest rate is really based on the Fed funds rate, so where the central bank is setting short-term rates.
The Federal Reserve Open Market Committee raising the funds rate by 75 basis points.
The Federal Reserve raised short-term interest rates by 75 basis points on June 15th. And that was a big move.
So when the Fed hikes its policy rate, it affects a whole bunch of other rates in the economy. And so variable rates for mortgages are anchored on short and long-term interest rates. And the short-term rate, which affects the long-term rate, is all set by the Fed. And so if the Fed is raising the policy rate, that means that anybody with a variable mortgage is facing higher interest costs on their mortgage. And so that means as the Fed's tightening and hiking interest rates, they're also making mortgages more expensive. That should cool down the housing market. That is a big part of the point. So mortgage-backed securities are basically a series of mortgages that are on a bank's balance sheet that are sort of bundled and repackaged and sold off.
Mortgage-backed securities are a relatively small part of the Fed's balance sheet. Treasuries are still the lion's share, more than 80%. The Fed's influence over housing through MBS purchases is complicated. It's partly direct. The fact that they're buying bonds means there's a smaller quantity, which has a direct impact on interest rates, but it's mostly psychological. That is, when the Fed announces a significant buying program, the market starts to anticipate, particularly pension funds and insurance companies. These are bond investors who need both very safe assets and very long maturities. So these are natural buyers of mortgage-backed securities, and they immediately start to worry about their ability to get those bonds at decent interest rates in the future, so they step up the pace of their borrowing. And because of that, when the Fed simply comes out and announces a borrowing program, you'll often see decline in mortgage interest rates of 0.5% to a full percent within a couple of months, even before the program begins.
With the Fed now saying it will do an additional $15 billion of purchases of mortgage-backed securities today. That's on top of $32 billion it was already going to do.
When the Fed bought mortgage-backed securities in the financial crisis, it was very different from when they bought them during the pandemic. Although I suspect the logic at the beginning of the pandemic was based on the logic of the housing crisis. During the housing crisis, literally thousands of mortgage lenders went out of business. They were actually highly levered themselves. Many of them had huge exposure to the mortgage market. They lost an enormous amount of money. They had margin calls, and they disappeared. Fannie Mae and Freddie Mac, which are absolutely central to the U.S. housing market, this is the primary place where mortgage loans are converted into mortgage-backed securities. They also had tremendous exposure to the mortgage market, and it turns out they had a tremendous amount of leverage as well. They had to be bailed out.
We're continuing the process of significantly reducing the size of our balance sheet.
Fed began to shrink its balance sheet on the 1st of June this year.
So it could cool the housing market. In theory, that's what's supposed to happen. In practice, we don't really have much evidence of that. There was the argument that the real estate market in the US was overheating already long before the Fed started rolling off MBS, mortgage-backed securities, from its balance sheet. And so there was an argument that actually the Fed should prioritize getting rid of mortgage-backed securities over getting rid of government bonds, for example, because the housing market was really overheating, partly because the Fed was such a big player and was creating demand for mortgages.
If the Fed stops buying MBS altogether, I think it should be a relatively small impact as long as fixed income investors are comfortable with the idea that mortgage rates are at their high.
An important thing to remember about the housing market is that housing can bring the economy up, and housing can also contribute to a slower level of growth. When people buy homes, they go out and spend the money elsewhere in the economy. And when housing starts to slow, some of that spending starts to slow.
It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all.
The Fed is fighting inflation in a way that we have not seen since 1981. In the last 45 years, any time recession signals began to flash, if the Fed was hiking rates, they stopped. After a considerable pause, if recession warnings continued to flash, they eased. We have been told repeatedly by Fed officials they're not going to do that this time. In fact, Jay Powell told us that the bigger mistake would not be causing a recession, it would be failing to control inflation.
The worst mistake we could make would be to fail, which it's not an option. We have to restore price stability. We really do. Because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work.
I think the likelihood of recession, probably before the end of this year, is extremely high. And I think even if we have a recession, the Fed will continue to hike. I cannot imagine under those circumstances that we don't have some kind of correction in the housing market.